For decades, Japan has maintained ultra-low interest rates, quietly influencing the global financial landscape. While other economies experience cycles of growth and contraction, Japan's consistent approach to near-zero rates provided stability and predictability that investors worldwide came to expect. This environment encouraged a steady global search for yield, as investors sought higher returns in riskier markets, supported by the ability to borrow at low cost in yen. The Bank of Japan's policy of zero and negative interest rates made borrowing in yen highly accessible for global financiers. This availability of inexpensive capital became a key element in many investment strategies. As a result, significant amounts of yen were invested abroad, supporting projects in markets across continents and establishing Japan as the world's largest creditor nation. Japanese capital played a substantial role in global economic activity, from Wall Street to emerging markets. Recently, after a prolonged period of low inflation, prices in Japan have begun to rise. This signals a notable change, as the country starts to move away from its extended phase of easy monetary policy. The Bank of Japan's decision to begin normalizing policy represents a significant development. Global markets are now adjusting to the end of a long-standing financial environment, with some uncertainty about future conditions. Japanese investors hold large portfolios of foreign assets, such as U.S. Treasuries, European stocks, and emerging market debt, based on the expectation that yen funding would remain inexpensive and accessible. This expectation is now being reconsidered. As the factors supporting the yen carry trade begin to shift, global attention is focused on Tokyo. Observers are monitoring how Japanese interest rates may change, and what implications this could have for international capital flows. The outcome will influence whether global markets adapt smoothly to these changes, or if there will be a more challenging adjustment as long-standing investment strategies are re-evaluated. This represents a gradual and significant shift in the financial landscape, a quiet transformation with the potential to influence the future of the global economy. The yen carry trade is a straightforward financial strategy. Borrow yen at ultra-low interest rates, then invest those borrowed funds in foreign assets or markets that offer higher returns, and keep the difference as profit. While simple in concept, this approach has had significant effects on the global financial system. For many years, Japan's consistently low interest rates made this strategy appealing to global investors. The availability of inexpensive yen contributed to increased liquidity and rising prices in stock markets and real estate worldwide. The effectiveness of the carry trade relies on a stable or weakening yen. If the yen strengthens unexpectedly, the cost of repaying loans increases, which can reduce or eliminate profits. The Bank of Japan's long-standing commitment to easy monetary policy kept the yen relatively weak, making the carry trade seem low risk and allowing it to grow substantially. Japanese capital has played a quiet but important role in financing U.S. government debt, supporting corporate growth and funding infrastructure projects in emerging markets. In this way, Japan has become a significant, though often understated, participant in the global economy. This widespread reliance on accessible Japanese funds has introduced a degree of vulnerability, as markets have become accustomed to the steady flow of yen. As Japan now signals a move toward tighter monetary policy and higher interest rates, the carry trade is beginning to unwind. This change may lead to lower asset prices, increased volatility, and potential risks across interconnected markets. The same mechanism that supported global growth for years could now reveal underlying weaknesses as the flow of capital adjusts to new conditions. Investors and policymakers worldwide are monitoring the situation, assessing the possible effects of this transition and the extent of its impact. As global finance enters a new phase, careful observation and analysis will be essential to understanding the outcomes of these changes. The Bank of Japan has raised its key rate to 0.75%. While this is a modest figure, it represents a significant departure from the country's long-standing policy of zero or negative interest rates. This decision signals the conclusion of Japan's extended period of deflation and the beginning of a new phase for its economy. The timing is notable as other central banks are now considering rate cuts, introducing new dynamics into global financial markets. For Japanese investors, this is the first time in many years that domestic capital has a clear incentive to remain within the country or even return from abroad. The previous era of exporting low-cost capital is ending, as Japan now offers comparatively higher rates. As a result, the basis for the yen carry trade has shifted, altering the risk and reward profile for global investments. This process of adjustment is now underway. A 0.75% rate adjustment may appear minor, but it marks a transition away from a long period of highly accommodative monetary policy. Markets tend to focus on the direction of policy changes rather than the specific rate itself. Investors are now considering not only the current rate, but also the likely trajectory, how much further rates may rise, and at what pace. This environment introduces a need to reassess risk across a broad range of global assets. The carry trade, which was previously considered relatively stable, now faces increased risk as borrowing costs move higher. Each rate increase reduces the margin that made the trade appealing, prompting investors to reevaluate their approaches. Japan's long-standing position as a zero-rate anchor has shifted, introducing higher rates and greater policy uncertainty. The emphasis has moved from taking advantage of a stable rate difference to managing a more variable one. For these reasons, even a modest rate increase from Tokyo is having a noticeable impact on global markets. The landscape is evolving. One of the most significant factors currently influencing global markets is the potential unwinding of the yen carry trade, a financial strategy that has supported international investments for many years and is now approaching a period of transition. As Japan gradually raises its interest rates after a long period of very loose monetary policy, the advantage of borrowing yen at low cost and investing in higher-yielding assets abroad is diminishing. The narrowing gap between Japanese and foreign rates is reducing returns for investors who have depended on this approach. When the potential reward no longer compensates for the risk, investors begin to unwind their positions. This involves selling foreign assets, converting the proceeds back into yen, and repaying the original loans. While this process is complex, it is a standard part of financial market adjustments. If a large number of investors choose to unwind at the same time, markets can experience notable movements, and liquidity may become less available for a period. As more investors purchase yen to close their trades, the currency's value tends to rise. This further reduces the appeal of the carry trade, encouraging additional unwinding, a feedback effect that can accelerate the process. The outcome may include a stronger yen, lower global asset prices, and tighter financial conditions. Such shifts can occur even when investors are well prepared. Given the scale of the yen carry trade, representing trillions of dollars in global exposure, a significant unwind would have broad effects, influencing currencies, stocks, and bonds in many regions. If the adjustment proceeds gradually, markets are generally able to adapt. However, a rapid shift could present challenges similar to those seen in previous market corrections. For this reason, central bankers worldwide are closely observing these developments, aiming to support a smooth and orderly transition. Careful monitoring of the unwinding process is now a key focus for investors, regulators, and policymakers. Each development is being evaluated with attention to detail. The implications are substantial. The way this transition unfolds will influence the stability and direction of global financial markets. As the process continues, the global financial community remains attentive to how this reversal of capital will progress. The process of unwinding the yen carry trade is not limited to Japan. Its effects are likely to be observed across global markets. U.S. Treasuries, which are commonly held by Japanese investors, may experience increased selling activity. This could result in higher yields and elevated borrowing costs. Emerging markets such as Brazil and Mexico, which have benefited from Japanese capital inflows, may see their currencies weaken and experience market adjustments if capital is withdrawn. Historical events such as the 2008 financial crisis have demonstrated how disruptions in one market can influence others. U.S. equities could be subject to increased selling as global investors adjust their risk exposure and move funds. Financial institutions with significant exposure to the carry trade may encounter solvency challenges, which could contribute to tighter credit conditions. The high degree of interconnectedness in today's financial system means that developments in Tokyo can have implications for markets in New York and elsewhere. As a result, the potential for financial contagion remains a consideration for global markets. The unwind is beginning to appear in various markets. The Japanese yen is gradually strengthening, which reduces the profitability of the carry trade and encourages investors to reconsider their positions. As a result, high-yield currencies such as the Mexican peso and Brazilian real are experiencing some weakness as capital flows shift. Japanese government bond yields are moving higher, making domestic assets relatively more appealing and leading to a decrease in demand for foreign bonds, including U.S. Short-term strasibusbakter chipindiger industrizakter strikerbregeries. This trend is contributing to a gradual increase in global borrowing costs and a reduction in overall liquidity. Recent data indicates that Japanese investors are repatriating funds, selling foreign assets in favor of domestic investments. These developments suggest that the process of unwinding is underway. The effects on global markets are likely to continue as these adjustments progress. The process of repatriation is contributing to current market adjustments. For many years, Japanese investors sought higher returns overseas, allocating significant capital to U.S. treasuries, European equities, and global real estate. With Japanese interest rates now increasing, domestic bonds have become more appealing, reducing the incentive to accept currency risk for additional yield. As Japanese investors reduce their holdings of foreign assets and repatriate funds, demand for U.S. treasuries declines, which can lead to higher borrowing costs in the United States. This repatriation influences a broad range of asset classes, resulting in lower liquidity and softer prices across global markets. The movement of capital is exerting a deflationary effect, counteracting the asset inflation seen in previous years. Capital flows are now returning to Japan. Global markets are adapting to this shift in capital allocation. The period of Japanese capital significantly supporting international markets is drawing to a close. Japan's policy adjustment will not result in an immediate disruption, but instead signals a gradual and significant transformation in global finance. The process of unwinding the carry trade is expected to unfold over several years, likely introducing ongoing challenges for growth and contributing to increased market fluctuations. The period of straightforward, predictable returns driven by inexpensive Japanese capital is coming to a close. Investors will need to place greater emphasis on risk management and adopt a more selective approach as access to low-cost leverage diminishes. Policymakers are likely to encounter higher borrowing costs and increased volatility, making collaboration with the Bank of Japan increasingly important. Decisions made in Japan now have a direct influence on borrowing costs in Washington and on the stability of markets worldwide. The era following 2008, characterized by coordinated monetary easing, has shifted. Policy divergence is now a defining feature. Monitoring Japan's monetary policy has become increasingly important for anyone seeking to understand developments in the global economy.